Well, thank you for inviting me to participate in the TheCityUK National Conference. I want to start by emphasising the importance of the role of TheCityUK and the relationship with the Bank of England. And this year, perhaps more than ever, we've drawn on that relationship to exchange views at times of great stress and challenge for the country as a whole. So let me start, if you don't mind, with a bit of an anecdote, which may at least provide some light relief in these times. And it's a little bit about the sort of prehistory of the UK. 20 odd years ago, I was the governor's private secretary at the Bank of England. At the time, there was a need to preserve and revive one of TheCityUK's predecessors, British Invisibles. The governor of the day, Eddie George, was involved. And he asked Douglas Hurd, previously Foreign Secretary, to conduct a review. The governor decided to visit Douglas Hurd at his office in NatWest in Bishopsgate to discuss the review. The governor and I drove there. I know it's not far, but we drove there. We pulled up outside of NatWest in Bishopsgate in heavy traffic. Now, the governor was on the curbside. His private secretary was not. And his private secretary had to get out and avoid being run over. The governor was into the NatWest first. Unfortunately, it was the wrong NatWest. It was a branch. I got into the branch to hear the governor announce to a cashier that he was the governor of the Bank of England and he would come to see Douglas Hurd. She gave him a look and said, "You're winding me up, mate." We retreated. Fortunately, we found Douglas Hurd. The review was done and the lineage can today be traced to TheCityUK. So let me get on to the serious stuff. I want to talk about the future for business investment in the age of COVID and the role of financial services. So let me start with a bit of recent history. Since the global financial crisis, business investment in the UK has been weaker than in previous expansions. And investment growth has been unusually weak relative to employment. It's the story of weak productivity growth. Globally, there's a well-established story of an excess supply of saving relative to investment opportunity, which underpins the pretty much consensus view that so-called neutral interest rates, the equilibrium rate, will stay low for the foreseeable future. But let me stop for a moment on this question about the lack of investment opportunity, because there are several strands to this story. I'm going to touch on one that is certainly relevant to the UK situation. Economic theory indicates that heightened uncertainty about the future tends to have a negative effect on investment. It increases the attraction of waiting to see how that uncertainty can be resolved. Now, both COVID and the process of setting the future relationship with the European Union have increased uncertainty. We see this in surveys, and it has restrained investment. Now, let me be clear, I'm saying this not in the sense of passing any judgment on Brexit. As a public official, I take no position on that, and nor am I passing or do pass any judgment on the handling of COVID. That's not the point. But our job at the Bank of England is to call it as we see it. So yes, uncertainty does reduce investment. And as we said in our recent monetary policy report, business expectations for sales next year remain subdued, as do measures of investment expectations. Now, we published that report not far off 2 weeks ago. And since then, we've had encouraging news on the vaccine front. Of course, there's a lot to do. There are important steps to take and evidence to be gathered. But this is a big step forward, and it will play a major role in lowering that level of uncertainty. So let me thank those in businesses, universities, government, and the NHS who are doing the vital work of pushing this progress forward at such impressive speed. If we can now begin to see some light at the end of the tunnel, we need to focus more on important questions about how our economies will look in the future, how we want them to look, what will be the legacy of COVID, and what we can do to support and prioritize any necessary more structural changes. Economics is often called a dismal affair, And as befits that, we tend to talk about, in unfortunate terms, about scarring to the economy. Now, we tried to refocus that in the monetary policy report and instead look at how the structure of the economy may change in the future. We described it in terms of three potential components of the change. How what we buy has changed and the way we buy it, how the way we work has changed, and how what we make may need to change. If these changes persist, they could require a reallocation of labour and capital. And this reallocation could be more or less costly. Now, I should emphasise that none of us have good answers yet to how much these changes will persist or even increase over time. But my best guess is that there will be lasting changes, and we can draw on some evidence from history to support that view. Let me also add two further views at this point. One is that we may see a reversal of the period of low productivity growth that I referred to earlier. COVID may, interestingly, be the spur, the change agent, if you like. Second, we must now focus and push ahead hard with the necessary changes to support changing the direction of our climate. Now, all of this will require investment on a much larger scale than we've seen in recent years, and that investment will need to be financed. But before I go on to the issue of financing, I want to elaborate a bit more on the point about scarring. I'm actually not a pessimist on the likely degree or consequences of the structural change that we may see. Now, that's in part because I'm not a literal reader of history in that sense. It's true that we saw deep and painful structural change in the economy in the late 1980s and into the 1990s, with a transition from heavy industry and mining to a much more services-orientated economy. That was a much more painful process with very difficult consequences, including a sharp increase in economic inequality. I don't believe that COVID will lead to the sort of intersectoral change that we saw in the 1980s and 1990s. I think it's more likely to be a case of intra-sectoral change, for instance, within services. Such a disruption can, of course, increase the mismatch of employment between firms and occupations, but we do have a labour market that has shown the capacity to adjust relatively quickly to such changes. Intra-sectoral change may also increase the likelihood that more capital can be redeployed and more rapidly than the sort of change we saw going back to the 1980s and 1990s. But the prevailing level of uncertainty here means there is no cause to be complacent on this front. And I hope you'd understand that you should expect a central bank to be cautious in this way. So let me now turn to the financing of investment. As I mentioned earlier, we live in a time where there appears to be no shortage of aggregate saving, but investment is weak. Indeed, the aggregate saving rate in the UK has gone up markedly this year as the opportunity to spend has fallen. But incomes have, on average, been supported. Though I should say that we are far from certain to what extent that higher saving level will persist. There is also a role for monetary policy here. As well as maintaining interest rates which are consistent with achieving the inflation target, in my view, the use of quantitative easing of asset purchases at a time like this can prevent and has prevented an unwarranted tightening in financial conditions, such as the tightening we observed in late March this year, but were fortunately able to deal with quickly. Now, to be clear, that's not monetary financing or fiscal dominance. It is instead the support of private finance via a well-functioning financial system, support for the economy, and thus for consumption and investment in it. Now, investment has to be financed. COVID has been a major shock to companies. In our August Financial Stability Report, the bank's Financial Policy Committee assessed that UK companies could face a cash flow deficit in the current financial year of up to around £200 billion, on top of having to refinance around £275 billion of debt maturing in this time period. It's not, though, all dismal news. Since the onset of the COVID shock, companies in the UK have raised a large amount of external finance, providing them with liquidity to help bridge the disruption. The UK financial system is playing a key role in helping companies manage the impact of the shock. A decade or more on, the financial system is supporting the economy, not the other way round. And that, of course, is exactly how it should be. This has been possible due to the resilience that was built up following the global financial crisis, as well as the extraordinary policy response of the government, if you don't mind me also saying the Bank of England. But that is not the end of the story. More financing will be needed to ensure viable businesses survive and to finance the need for investment that I talked about. And we need to ensure that this is done without excessive leverage. While the current low level of interest rates supports the sustainability of UK corporate debt, high leverage would make the corporate sector more vulnerable to interest rate or earnings shocks. So what are we doing about this? At the bank, we are emphasising work on the supply of finance for productive investment, which is important for long-term growth and for financial stability. In 2016, the Treasury included in the FPC's annual remit letter that it should consider, subject to meeting its primary objectives in relation to financial stability, how the UK financial system might best be able to intermediate the supply of finance for productive investment. This year, the Treasury recommended that the FPC consider how financial regulation and changes to the financial system structure may have affected the balance between financial stability and the support of productive finance in all regions and nations of the UK. Now, this is very welcome, and I can assure you that we're on the case. We set out our current work in the August Financial Stability Report, with a focus on why defined contribution pension funds in the UK invest only a relatively small proportion of their assets in less liquid investments, reviewing whether aspects of our prudential regulatory framework create disincentives to investing in longer term and less liquid investments, and could be removed without reducing the safety and soundness of banks and insurers or policyholder protection. And finally, how investment fund structures can safely support necessary investment in certain illiquid assets. Now, these are all very important questions in terms of providing an environment in which investment can be made and investment can grow. So to conclude, this agenda is crucial and it will have our strong focus. It marries the modern functions of the Bank of England, the work of the Monetary Policy Committee, the work of the Financial Policy Committee, the work of our Prudential Regulation Committee and the Prudential Regulation Authority, with some of the best traditions of the bank in terms of its involvement in the city and its involvement in ensuring that there is a flow of finance to support investment. But of course, it requires a major commitment from the financial services industry to support the economy, to support businesses and the people of this country as we get back on our feet from the effects of COVID and transform the economy to support climate change. Now, fortunately, I know from the many conversations that I've had with City UK during the course of this year, and indeed before that City UK is up for the challenge, and I believe the financial services industry is likewise, along with City UK, up for the challenge. So I look forward to working together in this vital work to come. Thank you very much.